Governments always tell you they are working for your financial freedom. They speak of stability, growth, and opportunity. It sounds reassuring, but when you look more closely at history, the picture changes. The past shows us that governments have repeatedly relied on hidden financial mechanisms to concentrate wealth and power in their own hands while keeping ordinary people under constant pressure. And perhaps the most disturbing truth is this: none of these tricks are new. The same game has been played for centuries. Only the packaging changes, the names change, but the objective remains the same: to move wealth upward and keep the majority dependent on the system. The oldest and simplest trick is inflation. When a government spends more than it can collect through taxes, it faces two choices: openly raise taxes, which is politically dangerous, or quietly reduce the value of money. By weakening the purchasing power of every banknote in coin, the state imposes a hidden tax without asking consent. Ancient Rome understood this well. In the 3rd century AD, rising military costs pushed emperors to reduce the silver content of the denarius. What was once nearly pure silver became copper coated with a thin layer of silver. The empire claimed nothing had changed, but people felt it immediately. Prices rose, savings disappeared, and wages lagged behind. Today, the same process continues. Only mints have been replaced by central banks. In the Middle Ages, the game took another form: forced loans. Kings in England, France, and Spain compelled wealthy merchants and guilds to lend money to the crown. Refusal meant punishment, confiscation, or worse. Repayment, when promised, often came late, devalued, or not at all. The state maintained its wars in splendor, while merchants sacrificed their capital. Coercion was presented as duty, obedience as patriotism, and it worked for centuries. By the 17th century, the trick became institutionalized within the financial system itself. The founding of England's central bank in 1694 was driven by the need to finance war. Wealthy investors bought government bonds, while interest payments were guaranteed through taxes paid by ordinary people on goods like salt, beer, and cloth. The wealthy earned secure returns, the poor funded them. This was a structured transfer of wealth disguised as national finance, a pattern that still exists today. In the modern world, these mechanisms are everywhere. Governments run massive deficits, issue bonds, and speak of infrastructure, jobs, and social support. Yet much of the money flows to defense contractors, corporate subsidies, and bailouts. When repayment comes due, taxes rise, money is printed, and social benefits are cut. The burden falls on the public. The gains go to bondholders. The 2008 financial crisis exposed this clearly. Banks took reckless risks and nearly collapsed the system. Taxpayers paid the cost. The same banks emerged larger and more powerful. Profits were privatized, losses socialized, all justified as necessary to save the system. Pension systems followed the same logic. Contributions were spent, not saved, leaving only promises that future generations would pay. As populations age, systems strain, leading to reforms that reduce benefits and delay retirement. Language masks reality at every stage. Inflation is called growth. Debt is called investment. Bailouts are stability. Cuts are reform. So are reform. Behind the words lies a consistent transfer of wealth from the many to the few. Complexity ensures most people never see it. From debased Roman coins to modern balance sheets, The mechanism remains unchanged. History shows these tricks always return. What changes is whether people recognize them. Most do not. And that ignorance is the most powerful tool of all. Look beyond the headlines. Ask who benefits. Inflation is not fate. It is policy. Systems protect themselves first. The game that impoverished Roman citizens is still being played today. Only the language has changed, and the answers remain in the past.